Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Welcome into the Friday, October 14 Market Plus. Back again with us, Elaine Kub, Don Roose, and Jeff French. Elaine, you've done these panels. Don, you've done these panels. Do you think we were nice to Jeff?
I think so. I think that was a good, easy, soft pitch. Yeah?
Yeah? Did you feel beat up on?
No, not at all.
Okay. We asked Don all the tough questions. We're going to ask him the first tough one here. Don Roose with U.S. Commodities. Don, Matt in Amherst, Wisconsin wants to know, are these prices, and you can talk in generalities, are they the new normal?
Well, these are historically the highest prices we've ever had this time of year. And I would say that, over history, the reason prices have not really accelerated like you would think, because we don't sell a price, we sell gross dollars per acre. And what's happened over history is the yield has gone up. And I suspect that what's going to happen is the yield on corn, the yield on beans continues to go up. And I suspect that the price doesn't stay at these price levels for over history. So look at your gross dollars per acre. That'll be more the tell of the tape than the price that you're at today.
It's making us do math already. Do you agree with that, Elaine?
Yeah, largely. The other thing to think about is like cost of production. Right? A commodity market is always going to eventually revert back to the cost of production to drive producers out of business, inefficient producers out of business. And cost of production has gone up. I don't know, fertilizer prices probably won't be this high forever and ever, but seed prices probably will, more machinery prices probably will. So cost of production has probably gone up sustainably to not this as a new normal, but higher than it was.
Haven't we taken the inefficient producers out of the equation already?
Well, somebody somewhere is the most inefficient producer. It may not be
here,
it may
but
be
it's
in Brazil.
relative, though.
Somewhere in the world is the most
inefficient
producer,
Okay. That's a discussion for another day.
Like Lake Wobegon, like everybody's children are above average.
But this is, it's a dangerous time because, the last time I remember this was through the, I'm a little bit older guy here, in the late 70s, 80s, when everything just inflated, prices went up, land values went up, machinery, everything went up. And then we found out, like we are today, we can't live with these prices this way. And so then we gradually took interest rates up and everything kind of contracted. And then we started again. So just a concern.
Do you buy all that? Anything else? No?
Yeah, it's concerning, and it doesn't look like the Fed is going to slow down here. I mean, it's all indications that rates are going to continue to rise, especially with the CPI number this week.
I think I asked you this summer. Do you think that the Fed should stop the rate increase just to see what that does? Do something a little different than what everybody's expecting them to do?
Well, I think then you're going to see prices continue to rise, so I don't think they can do that right now.
Okay. All right. I'm going to ask you Jake in Indiana's question first here, Jeff. He asked us on Twitter. He's saying store and ignore has been the way to go strategy for producers for the last couple of years. Should I weld my bin door shut like in recent past or move this crop out sooner given the volatile nature of the world?
It's definitely been the way of the last 2 years. I mean, you look at beans, the low in October the last 2 years, and then we rally $3 to $4 a bushel out into February. But we are at higher levels this year. We're $1.80 higher compared to last year right now this time in the bean market. So I like these prices. I have no problem selling off the combine. I'm just going to defend that position with some July calls because we don't know what South America weather is going to bring. They are forecasting a giant crop, but right now down there, it's about their April. We all know how that goes.
We alluded to it a little bit in the first discussion, Elaine, about basis. There's some wide basis changes because of the river issue. Can you afford to sell off the combine if you're close to the river right now?
And that's not the only market that folks in that region have. They do also have ethanol markets and livestock markets to feed into. That is a really tricky position to be into. And I do like the idea of using the bin space that you have and using the logistics that you have to move that grain in the spring if that's what you're used to doing. But as Jeff is mentioning, these prices, you can take advantage of the futures prices, the overall flat price level, without touching the basis at this point in time. You can do that with the use of futures and options.
Is the basis as a whole right now where you would expect it to be for the middle of October?
Well, the average basis, yeah, is fine, but average basis is including some really wide differences. corn prices are $8.50 in the Panhandle of Texas and 80 under in North Dakota. I mean, so it's almost meaningless to talk about it as a whole.
Meaningless is my middle
You know, I
name.
think, one thing that this year there's going to be a huge dislocation, and it's going to be a transportation issue. But, we think probably Kansas, Nebraska, western Iowa is probably going to be short 800 to 850 million bushels of corn, feed grains. So how far does that pull to the east, and what's that do to the basis? So it's going to be a really interesting, challenging year from that standpoint. Basis levels are going to be pretty hot down there, and how far does it move into the east?
And we haven't even really mentioned the railroad story, because that could be one solution in some of those spots is the railroad, but we might have a strike come middle of November. Do you think that's going to be factored into the trade already?
Well, hopefully we don't get into that, but yeah, because when you start trucking grain down there, which I mean we're going to have to, you're not going to liquidate a herd down there much more than it already is. So I think it's something we really have to watch really pretty close. But we're going to have that dislocation. I feel comfortable with that.
All right, Elaine. Don in Monticello, Iowa wants to know which has a better upside in futures, corn or soybeans?
Oh, I think soybeans. I mean, for all the reasons that Jeff has been talking about corn, like just sell the corn, right? There's not a whole lot of upside that I can see for corn. Not that there's anything wrong with this price level. I mean, I'm fairly neutral at this price level, but what are you going to do more bullishly than it hasn't already been done? Soybeans, however, I can make a bullish case, not a bullish case back to $16, not a bullish case back to $17, but I can make a bullish case for another 50 cents or another $1 if you had some sort of weather scenario in South America, which of course is 50-50, nobody knows at this point, but it's a maybe, or even just the volatility of the markets generally, you might get 50 cents in there. And because, as I mentioned, China buying the soybeans and the sort of bottoming out of the edible oils market, I can kind of make a case for soybeans to go a little higher. Higher.
Can you make a case?
Oh, absolutely. I mean, the beans, if you look from a month ago, we liquidated $1.50 a bushel. To get out of that down channel, though, I want to see November above $14.35. I mean, that will negate this downturn, and you would probably see some fun buying on a close above $14.35.
What moves the market that way?
Weather, China buying, which we saw this week. They've been pretty quiet. And then the funds just, they don't matter what price it is. As long as it's going their way, they'll continue to put money to it.
The algorithms speak.
That's right.
Okay. Don. No, wait. Elaine got the question, so it goes Don now, right?
Yes.
I don't want to get her out of turn.
I'm
Don.
open. Yeah.
Scott in Augusta, Wisconsin. This is just going to reiterate something. Yields keep dropping on beans and corn, but why isn't there much of an increase in prices? We've already said this again. I just want to hear it one more time.
Kind of the same. I think because we already had an increase in prices, and you have to be careful if it's a short crop, long tail. And the economy continues to get worse, not better, and our exports continue to get worse, not better. So I think it's more about the supply is baked in, and we have a huge crop in South America that's in the oven. Does it get cooked, or what's going to happen? So we're going to watch that close.
All right, Elaine, this is a little similar. Again, I just kind of want you to reiterate something that Jonathan in Wisconsin was asking. Are we going to finally run into commodity availability with grains, fertilizer, et cetera? It seems like this year we could get what we wanted if you paid enough. But with low river levels, the rail strikes, the lack of trucks, will supplies be limited? And I guess how you deliver it.
No, you touched on that, and Don touched on that, but the rail strike, it would be bad. Yeah, if you had no barge, no rail, all you were doing was trucking stuff, it's a bad scenario, and you talk about paying for it if you need it. I mean, how much would you have to pay to move corn from Illinois to the Panhandle of Texas by truck? I mean, it's not a movement that is typically done. It would be bad. Let's just hope it doesn't happen.
Well, because you think of on the farm, you take that grain, you take the corn 20 miles to the destination we want. You think that's a long way. Imagine adding a zero to that.
Yeah, and there's not availability of truckers either. I mean, it's not going to, it would be a nightmare.
So, in the economic sense of things, the likely position is the railroad workers may have some leverage in negotiations. Therefore, a railroad company is going to have to look to pass on costs, which pass on costs, the consumer ends up paying.
Right, and I was just going to say, the railroad companies, their agriculture customers are not their favorite number one customers. That's not the most profitable line of business that they're in. Coal and oil and the energy commodities and lumber and more high value commodities are more important customers to them from a profitability standpoint. But they're in the same position too, that supply chain wise, they do not want a rail strike either. Nobody wants a rail strike.
Right.
Yeah.
All right, Don, we're going to close with this question. KB in Manitoba. We're going to go to Canada here. Assuming fundamentals, the U.S. dollar, the Fed rate hikes, inflation, recession, logistics, Ukraine, Russia, all of this is priced in. Assume that's all priced in. How should we be preparing for global liquidity issues, contagion, as ag market participants?
Well, I think you have to look back over history in a lot of these markets, and I think what you're alluding to is the extreme that we saw in 2008 when we had banking problems. Lehman goes out of business, some of the other foreign banks. So when you're at high prices, one of the reasons you use risk management is because you're not sure of what can happen in the unknown. Currently, right now, you're in about as shaky as an environment that we've had since, call it 2008, call it since the early 80s, but it's an environment where you want to protect yourself, Paul.
Jeff, I cut you off in the main discussion. You get last word. Anything else you want to add about this discussion?
Well, risk management next year is going to be key. I mean, you look at new crop prices, $6.30 a bushel, corn, $13.50 beans. There's going to be opportunity there, but there's also potential for some downside risk. So look for put options. You can lock in some good values here for the next year. So if prices do get weaker, you can gain value that way.
Elaine, you optimistic about the rest of the year and early first half of 23?
Sure, what's not, I mean, you know, it's in a farmer's nature to complain about things, right? And input costs are high and whatnot, but come on, I mean, we look forward to selling things at these prices. This is a nice time for us.
And we look forward to seeing you the next time you come back, Elaine Kub.
Always a pleasure.
Don Roose, thank you as well. And Jeff French.
Thank you.
Hopefully it wasn't so bad.
It was great.
It was good. All right. That'll do it for this installment of Market Plus. Next week, we are going to look at the efforts in the fight against global hunger, and we'll have the analysis of Naomi Bloom. I'm Paul Yeager. Thank you so much for watching, listening, or reading. Have a great week.